You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Those nasty fees. You know, they're a necessity, but you got to be careful. You got to watch out for them. They can come back and bite you big time. And, well, yesterday's podcast led me to today's. In yesterday's podcast, I got a question about USAA Fund's new mutual fund management company, the company who bought USAA Funds, called Victory Funds. And in my research, I stumbled across a mutual fund from Victory that is broker sold. It is a small cap emerging markets fund. Now, that's a pretty specialized kind of fund, and I don't believe there are many of those out there. There aren't any that I know of that just leap right to mind. This fund, though, it has a 5.75% commission up front. And then it has actual gross internal management fees and expenses of 8.03% per year. That is one of the highest gross expense ratios I have ever heard. There have only been a couple higher. That's really, really high. And I understand that small cap emerging market stocks may be a little bit difficult to manage, but wow. However, Victory is absorbing all of that management fee above 1.75% per year until April of 2021. So they're only charging they're charging 1.75% until 2021 when they can raise it. And they also have the ability to recover, to reimburse themselves for all of the fees and expenses they've been eating. So current shareholders, while they're only paying, and again, the word only, while they're paying 1.75%, could end up paying back some or all of that 8.03% or the 6% over that, 1.75. Here's the thing about fees. Fees impact your return. A fiduciary advisor would be remiss, would be in violation of his or her fiduciary responsibility to sell you a fund like that when, while you can't get the exact fund, you could get a small cap U.S. fund and you could get an emerging markets fund for not just less, but far, far, far less. I'll give you a couple of examples. The Vanguard Emerging Markets Index Fund has an expense ratio of 0.14% per year. The Vanguard Small Cap Index Fund, which is U.S. stocks, but it's small companies, so you get small company-like performance, is 0.05% per year, or 1.7% less. And that kind of a difference in fees pretty much has to show up in the returns, and indeed it does. When you compare the 5-year return of the Victory Small Cap Emerging Markets Fund to Vanguard's other two funds, the Small Cap and the Emerging Markets, you see the stark difference. Even though, we're not talking apples and apples, we're talking apples and oranges, but we're still in the fruit category. The 5-year return for the Victory Fund was 6.7%, while the 5-year return for the Vanguard Emerging Markets Fund, admittedly larger companies slightly, it's 10.1%, or it was 10.1%. Same 5 years. while the Vanguard Small Cap Index returned 11.3% over that same 5 years. And the Vanguard funds did it with less volatility. So the fees do matter. Fees do matter. If you're doing it on your own, you should always pay the least amount possible. If you're hiring somebody to do it for you, you should pay the least amount possible for the services you desire, because it translates into less money if you're paying higher fees generally. The only exception is the Vanguard study that shows that hiring a fiduciary advisor increases the average investor's returns, not because of the fees charged, but because the fees charged provide advisors, or investors, I should say, with a service that has been proven to improve performance, and that is keeping you invested, keeping you on track, rebalancing regularly, that kind of stuff. So you need to watch the fees, and if somebody's a fiduciary, they are really required to sell you the least expensive product of its type. And many times they fail miserably to do that. If you have questions, call us at 855-935-TALK, 855-935-8255, or send your questions in at TalkingRealMoney.com on the contact form like this one. The subject, bond funds versus FDIC-insured money market accounts. Ordinarily, one should have money in stocks, money in bonds, and money in cash. But with interest rates so low, the sort of safe, short, or medium bond funds you recommend are paying almost nothing. At Bankrate.com, one can find FDIC insured and fully liquid money market accounts that pay far more. Doesn't it make sense, then, to put both the cash and the bond portions of the portfolio into these banks and earn very safe returns that are actually a bit higher than the bond funds? In ordinary times, bond funds have a modest upside potential if interest rates fall, and I know that ordinarily one cannot predict interest rates, but nowadays rates couldn't go down much because they're already so close to zero. Is there a flaw in my thinking? There's not a flaw in your thinking. I think your numbers aren't right, though. There is not a lot of room for interest rates to fall farther. However, there hasn't been a whole lot of room for interest rates to fall farther for years. And guess what they've been doing? I mean, I know my short-term bond fund went down a little bit earlier in the year, and now it's going back up a bit. I don't know why. It just does. But the thing is the Vanguard Short-Term Bond Index Fund, which is all high-quality bonds, corporate and government, has an SEC yield of 1.89% recently, as of like last week. Let me just double-check that. Short-Term Bond Index Admiral Shares, VBIRX. The yield was 1.89%. Yes, okay. Whereas the best bank rates I can find, money market or savings, high yield savings, are still well below 1%. They're well below 1%. The highest money market or high yielding savings account I could find was 0.7%. That's dramatically lower than a 1.89. Even a 1 or 3, let's use a 3-year, because the Vanguard short-term bond index has an average maturity of about 2.5, 2.75 years. So we'll use a 3-year CD rate for comparison's sake, to be fair. And the best CD rate is 1.15. But remember, that's not liquidity. That does not provide liquidity. You're in it for a while. unless you pay a penalty and you lose interest to get out. So everything's low. Just everything is low these days. I still have a lot of money in a short-term bond fund. Why? Because I know how they work. You see, with a 2.5 or 3 year maturity, if rates start rising, when rates start rising, because they'll rise someday, I just don't know when they do, yes, the value of my portfolio of the existing bonds in the secondary market will go down. But new bonds will be pouring in as the old bonds mature. And that, while my value will be down and probably stay down, my yield will gradually start rising. It's like an adjustable rate account, but that pays or has paid historically more than a bank account. More volatility, certainly, but that's the trade-off. So, yeah, your thinking is right. It's just that you're not going to make as much. You just can't do it. It's not possible. Again, send your questions in at talkingrealmoney.com or call 855-935-TALK, 855-935-8255. Next question, this is one sent in at talkingrealmoney.com. The subject, Bloom. I have to say it that way because they're extra O's. I've been seeing ads for this management/advisor company called Bloom. Yes, 3 O's. Just wondering if you folks saw this and what your thoughts are. I'm not planning to use them, more curious than anything. Well, Bloom is sort of a unique robo-advisor, and they're a robo-advisor. It's automated investing. We've looked into doing this, doing robo-advising, but there's not as much interest in that as there is in having somebody who's always there, kind of looking over your shoulder. Robo-advising is not as personalized, but hey, it's got its place in the market. There's lots of robos. Bloom is a flat rate per year company, and they only manage retirement plans. Now, they can manage your retirement plan at work, but only if it's in, I believe, Ameritrade. I can't swear to which ones, but it's a few of the big ones. It's only if it's in certain accounts, and I believe they charge like $250 a year to do that. They also manage IRA accounts. What's involved? Don't know. Never used them. Just recently heard about them, even though they've been around, at least 5 years. So just don't know much. But I do know they're very reasonably priced, and they do something unique in that they manage 401k accounts. But again, only if your company will allow them to do so. Now, a company like ours, for example, a good fee-only advisor, really, this is what they should do. If you have a 401k at work and you have an account with your fee-only advisor, they should charge you for managing the monies you have with them, but they should give you advice on managing your 401k for free. We do. In fact, we even do it for our clients' family because it should be part of the service because your account is one big thing. And it needs to be treated as an individual entity. The various parts and pieces need to be managed considering the others. And even if we don't charge for it, it would be irresponsible not to help you manage those. So, yeah, Bloom looks fine to me. Everything I've seen about it, I haven't seen any big complaints or problems, so I'm sure it's on the up and up. 855-935-TALK, 855-935-8255. Remember that number. You can call it any time. Leave your question on the answering computer. Leave as much information as you can. If I don't need all of it, I can edit it out, but send it all, and we'll answer your question on a future podcast. Or you can go to talkingrealmoney.com, click on the contact form, type it up, or speak it right there on your computer. Please tell everybody you know about the podcast. Because the more, the merrier, and the more who listen, the fewer who are going to get ripped off. Oh, and by the way, if you need more complex advice, if you've got a situation where you have an account with lots of moving pieces, you got some complex scenario, You don't think it requires long-term money management, but you need some help? Hey, get in touch with one of our advisors. They are there to help. No cost, no obligation, no sales pitch. And you can set up an appointment really easily at vestory.com. You just go to vestory.com and use the appointment scheduler. That's all there is to it. We'll do it remotely. Thanks for listening. Have a great one. We'll talk to you really soon. I'm Don McDonald.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?